Retail is a very hard business. Charlie Munger famously preached that. It's very competitive, margins are fairly low, and here's a company, Best Buy, which is basically focused on electronic retailers. TVs, smartphones, everything like that you get at Best Buy. The stock has moved nowhere since 2018, and revenue has moved nowhere since 2008. So after inflation, this company has been in a heavy decline, and that makes sense. You don't have to go to the store to buy your new TV. You don't have to go to the store to buy your new iPhone. You can go online, buy it, usually at a way cheaper price than in person, so Best Buy's business model is not really that great. The one saving grace for the stock has been the share buybacks. Since 2007, the amount of shares has more than halved. That kinda kept up earnings per share growth. But other than that, net income flat since 2017. Sometimes even down, sometimes a bit up. During the years after the pandemic, a lot of people bought in person. They really wanted to get into the stores. They didn't want to buy online, they just wanted to go in person. But over the last few years, they have taken on a lot of debt to buy back all these shares. 5 billion of net debt over the last 10 years. That is around 20% of the market cap. Now, some has to do with the increase in leases that they had because of accounting rules, but overall that's still a huge amount of net debt they took on. They basically have very little cash on hand anymore. They used to have 5 billion in 2021. Long term, the cash in the business is going down to buy back those shares. But of course, we can't always look into the past. How is the company doing right now? Comparable sales. So basically, if you ignore new store openings or store closures, how are the existing stores performing? Decline of 2.9%. That is horrible for retail. But that's better than they had it before. Last year was minus 6.9%. Domestically it was minus 9. America is most of the revenue. International, 700 million. Not even 10% of what the domestic segment makes. Now because of the share buybacks, that didn't matter. Earnings still went up. Some of that has to do with a slight margin increase, but this is also a lot of share buybacks. And then when we look at the domestic segment, how has that performed? 1% growth, 0.5% growth, 0.2% growth. Now then they had some years with a bit higher before and after the pandemic, but now it's reversing back to the mean. They had a few years where it was really great, everyone was buying electronics after the pandemic. During the pandemic it was hard to get a lot of new items, now people bought them, and now it goes back to normal. Minus 10%, minus 7%. So basically all these gains you had during the pandemic are gone. And now is the question, can they even keep this? Can they go back to this 0.2, 0.5, 1%? Or is it gonna stay like this? And I think it's not gonna go that well. Best Buy is not investing a lot in its stores anymore. CapEx has not really changed since 2015. It has grown up and down, but Best Buy is still what it is, a brick and mortar retailer. They buy stuff, gets delivered to them, they sell it to you for a profit. That business model gets worse and worse over time when you compare it with what other big e-commerce players invest in their delivery system. While maybe in 2015 it made sense for you to go to Best Buy, because if I order my TV, if I order my phone off Amazon, off this and this website, directly from a producer, how long will it take to get here? How hard will the return process be? Here at Best Buy, I know I have a person to talk to. But now, you can get a TV within 1 day sometimes from Amazon. You know the return policy is gonna be great. You know you have customer support, and everything is online. These were the times where Best Buy had a chance. Best Buy has not changed. And this is why retail is so hard. What is their moat? What is Best Buy's moat right now? That you can go in person and touch the phone, touch the fridge. And then you compete with Walmart. Then you compete with Costco if they also sell that. You have this unusually high profit margin from Best Buy because electronics are usually a higher margin. While the normal retail has maybe a 1.5% profit margin, Best Buy has 3. That might not sound like a lot, but that's a 100% increase. This is something where every retailer likes to eat into. They like to sell those high ticket items, like fridges, like smartphones. So a lot of it is going to be eaten by Amazon, by other e-commerce players who are able to ship it quicker to you, offer you a good warranty. They're able to undercut Best Buy. Then other players like Walmart are going to eat into your margin. So I don't really see Best Buy returning to growth. And I think once the older generations start dying, who are not used to the internet, who really like to go in person and buy those kind of things, who even need maybe for someone to deliver the item and install it at your house. That is an advantage Best Buy has. Amazon can't easily go to your house and say, hey, we will install your fridge for you. Best Buy can do that. Or hey, we will set up your phone for you. Best Buy can do that. An employee care can do it. Amazon can't do that. Why would you go to Best Buy? You can't compare prices that well when you're in a brick and mortar store. You can just go online and look up, buy from wherever is the cheapest. Then you look at a slightly declining business over time. So then I look at the cash flow. How much are we gonna get on average in cash flow? In good times, you get 2 billion. In bad times, you get 500 million. Currently, you get 1 billion. And then when I see you pay an 18 multiple on Best Buy, I don't really see how this is gonna work out. they're basically putting all their money into dividends and share buybacks, even more than they have right now really, and even more than the years before. They've been going into debt for some time. If times are great, they buy back a huge amount of shares, like in 2020, when they had the huge amount of cash coming in. But they're just kind of delaying the issue. Of course, you can mask underlying lack of earnings growth if you buy back 10% of shares. Your business keeps getting disrupted. You haven't grown in 20 years. Your margin keeps declining slowly over time. 3% decrease in margins, that's a lot for retail. So if we assume this 1 billion in earnings, that's gonna be slightly declining over time. How much are we willing to pay? Per share, that is 4.6. And then we think, what is gonna happen? Revenue has not grown in 20 years, basically. It's not gonna start growing now. You have only your share buybacks. Now the issue is, you could buy back a lot of shares if your stock is trading very cheap and you don't really have any expenses. That is the case with HP. That is why a lot of people like HP. The shares always trade at around a 10 PE ratio or even below, so they buy back 10% of shares. Easily doable. Best Buy is trading at an 18 multiple, plus they're paying out a huge dividend. When you look at their cash flow of around 1 billion, 800 million goes to the dividends, 300 million to the share buybacks. Of course, they have times where they had more money, but that is not the case anymore. The dividend has grown massively, so basically the biggest returns you're gonna get from the stock are the dividends. Unless the free cash flow shoots back up. Because if it shoots up by another 500 million, that 500 million goes into the share buybacks. I assume long term they're gonna only make 1 billion. Because I want to be conservative. This is a business which is getting disrupted, has no moat, no benefit to other companies, hasn't grown. So then I assume that they're only going to be able to buy back 2% of shares. Because if they only have like 300 million left, that's not even enough for 2% of the shares. And they can't go into debt forever to buy back more shares, as they're doing right now. So then, 75% of the cash flow gets paid out as dividends with a little deduction to taxes. Rest goes into the share buybacks. You get a 12 multiple. That's not a great company. 12 is already fairly high in my opinion. I think this would warrant a 10 multiple maybe. Then we come to $46 per share. It's currently trading at 85. It just doesn't make sense. Dividend is great, but it takes most of the cash flow. And the dividend is not even that high right now, because the stock is still trading at very high levels. Now what if it goes better? They're gonna go back to normal growth mode. 2 to 3%. We have 5% and 4%. And the 50 multiple, because it's an okay business now. We're still not at a 10% return. Now what if it goes really bad? Basically the free cash flow dips even more, so they're not even gonna be able to buy back shares, only the dividend. And then an 8 multiple, then you only get $33 per share. I just don't really see the upside in Best Buy. Sure, maybe it goes to 1.5 billion in free cash flow, that is still above a 10 multiple for a company which is not really growing. And then I think, why not get a business with a higher moat like HP? Best Buy has no moat. You can see that in the revenue. In retail you need a moat, otherwise you get crushed, and Best Buy has no moat, so I'm not buying the stock. What do you think about it? Write down below. Have a good day.